All right, stop scrolling for a second, because something just happened that most people won't fully understand until it's already over. Silver dropped 37% in less than 48 hours. Roughly $1.4 trillion in market value vanished, almost overnight. And while that was happening, JPMorgan quietly put out a warning saying silver could slide back toward $50 an ounce, which would be nearly a 50% drawdown from the recent $120 highs. That's not a random number. That's a message. And it matters right now, because this crash just exposed how fragile this entire move really was. Stay with me, because I'm going to show you exactly what broke, why it broke so fast, and how you can spot this setup before it happens again. Before I explain what caused this specific crash, let me teach you something most people never really internalize about markets. Price doesn't just move on good news or bad news. Price moves on positioning. It moves on who's in the trade, how levered they are, and how much pain they can take before they're forced out. Think of a crowded elevator. Everything feels fine going up until the cable snaps. The problem wasn't the last person who stepped in. The problem was that it was already overloaded. Silver wasn't collapsing because the story suddenly changed. It collapsed because the structure underneath it couldn't hold the weight anymore. And once you see markets this way, you start recognizing these patterns everywhere. When professional traders look at a parabolic rally, they're not just looking at the price chart. They're looking at the scaffolding. They're asking, who owns this thing? How are they funded? What happens if it reverses even a little bit? Because here's what happens in every single bubble, every single time. The move starts with real buyers, people who've done research, who believe in the fundamentals, who are willing to hold through volatility. But then momentum kicks in, and momentum attracts a completely different crowd. It attracts people who don't care about fundamentals. They care about the chart going up. They care about making money fast. And that's when leverage enters the picture. Now, leverage isn't evil. It's a tool. But it's a tool that magnifies everything. It magnifies your gains on the way up, sure. But it also magnifies something else that most people forget about until it's too late. It magnifies forced selling. See, when you're using borrowed money, you don't get to decide when to sell based on your thesis. You have to sell when your lender tells you to sell. You have to sell when the margin clerk calls. You have to sell when the exchange raises requirements. And that creates a completely different kind of market dynamic. It creates mechanical selling. Selling that has nothing to do with whether silver's going to $150 or back to $30 long term. It's just math. It's just liquidation. So what does that tell us? It tells us that the fastest, most violent moves in markets aren't usually driven by fundamentals changing. They're driven by structure breaking. They're driven by too many people holding the same position with too much leverage and not enough exit doors. And that's exactly what we just watched happen in silver. Now here's what was actually happening under the hood. Silver had rallied about 260% year over year, going almost vertical. That kind of move doesn't attract patient capital. It pulls in momentum traders, short-term speculators, and leveraged futures positions. Lots of them. Open interest ballooned. Volatility expanded. Exchanges tightened margin requirements. And that's the key. Because when margins rise, traders don't get a choice. They either add cash immediately or they sell. Let me explain how this actually works, because it's simple but brutal. Let's say you bought silver futures when it was at $80. You put up, I don't know, let's say 20% margin. So you're controlling $100,000 worth of silver with $20,000 of your own money. Silver runs to 120. You're feeling great. You've made money on paper. But now the exchange looks at the volatility. They look at how fast it's moving. And they say, you know what? This is getting risky. We're raising margin requirements from 20% to 30%. Now you've got a problem. You don't just get to keep riding the position. You have to come up with another $10,000 in cash, immediately. If you don't have it, they sell you out. They liquidate your position whether you like it or not. So when silver ticked lower, that selling triggered more margin calls, which triggered more selling, which triggered even more forced liquidation. It's a cascade, a mechanical cascade. And here's what makes it so dangerous. It feeds on itself. Each wave of selling pushes the price lower. Lower prices trigger more margin calls. More margin calls create more forced sellers. More forced sellers push the price even lower. It's a liquidation spiral. And once it starts, it doesn't stop until all the excess leverage is flushed out of the system. But here's the part that should make you nervous if you weren't watching closely. The speed. A 37% crash in 2 days isn't emotional selling. That's forced selling. That's the market flushing leverage as fast as it possibly can. When you see moves this violent, this fast, you're not watching investors change their minds about the fundamentals. You're watching a machine clear positions. You're watching the market's immune system eject everyone who is holding on borrowed money. And there's a second layer here that made this even worse. Physical silver and paper silver are connected, but they're not the same thing. Most of the leverage in silver isn't people buying bars and storing them in a vault. It's people trading futures contracts, options, ETFs, all kinds of derivative instruments that are supposed to track silver, but don't require you to actually own the metal. And when those paper positions start unwinding, liquidity disappears. Think about it. If you need to sell a futures contract and everyone else is also trying to sell at the same time, who's buying? The only buyers are people who want to catch a falling knife, or market makers who are going to demand a massive discount. So prices gap. They don't drift lower, they crater. That's why you saw silver go from $117 to $73 in what felt like seconds. It wasn't a gradual reassessment of value, it was a liquidity vacuum. And in a liquidity vacuum, price discovery breaks down completely. The price you see isn't what silver's worth. It's just what the next desperate seller will accept to get out. Here's what's wild about this. It didn't matter if you believed in silver's long-term fundamentals. It didn't matter if you were right on the macro story. When liquidity thins and leverage unwinds, the market stops caring about narratives. It only cares about clearing positions. I've seen brilliant analysts, people who nailed the thesis, who understood the supply dynamics, who knew industrial demand was rising, who predicted the whole rally, and they still lost money because they ignored positioning. They ignored leverage. They assumed that being right about the destination meant they'd be safe on the journey. And that's just not how markets work when structure collapses. And if this feels familiar, it should. This is the exact same playbook silver has followed before. In the late 1970s, silver had massive speculative excess, then suffered a brutal mid-cycle drawdown of roughly 50% before eventually resuming its longer-term trend. You had the Hunt brothers trying to corner the market. You had leverage stacked on leverage. You had retail piling in at the top. And when it broke hard. Silver went from $50 an ounce down to under $10 in a matter of months. It destroyed late buyers. It shook out everyone who was in it for the momentum. And only after all that pain, only after all that deleveraging, did silver eventually build a base and start moving again. Same thing in 2011. Silver ran hard into the mid-40s, peaked around $48, then collapsed nearly 50% over the next few months. I remember that move. I was watching it in real time. You had all the same patterns: parabolic chart, leverage expanding, open interest at record levels. Everyone talking about silver going to $100, $200. And then, boom. Margin requirements increased, liquidations started, and the whole structure came apart. It wasn't that the bull market was over forever. It was that the excess had to come out first. The market had to reset. It had to flush out the weak hands, the leveraged traders, everyone who was there for the wrong reasons. When you zoom out, you see the pattern clearly. Parabolic moves invite leverage. Leverage creates fragility. Fragility leads to violent mean reversion. The larger story isn't that silver fails, it's that silver punishes excess before rewarding patience. And that pattern has played out over and over again, not just in silver, in oil, in crypto, in tech stocks, in every single asset class where speculation takes over from investment. The fundamentals might be real, the long-term story might be sound, But if the structure gets too unstable, if too many people are holding with borrowed money, the correction isn't optional. It's mechanical. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be manipulation? Could JPMorgan be talking their book? Let me be honest. Banks always talk their positioning. That's not new. If they're short silver, of course they're going to put out bearish notes. If they're long, they'll put out bullish notes. That's how the game works. So yes, you could look at that JPMorgan report and say, well, they've got an agenda. They want silver lower. And you might be right. But here's the thing. You don't need to believe anyone's motives to read the tape. The price action already confirmed the risk. A $1.4 trillion wipeout doesn't happen because of a press release. It happens because the market was structurally unstable. It happens because there were too many longs, too much leverage, too little liquidity. JPMorgan didn't create that setup. They might have pointed at it, they might have nudged it, but the dominoes were already lined up. All it took was a push. So instead of arguing about villains, focus on what you can control. Focus on leverage. Focus on entries. Focus on risk management. Because whether this was manipulation or just market mechanics, the result is the same. If you were over-leveraged, you got hurt. If you chased at the top, you got hurt. If you didn't have stops, you got hurt. That's not conspiracy. That's just reality. And the best traders I know don't waste time trying to figure out who's pulling strings behind the curtain. They study the setup. They watch positioning. They manage their exposure. And they let the market tell them what's actually happening, instead of imposing their preferred narrative on it. There are probably 3 types of people watching this right now. First, there's you if you chased silver near the highs. Maybe you bought at 110, 115, thinking it was going to 150. Maybe you used leverage because everyone was saying this was the trade of the decade. If that's you, I get it. Momentum is seductive. When something's ripping higher every single day, when everyone around you is making money, it feels like you're going to miss out if you don't jump in. The lesson here isn't shame. It's structure. Ask yourself whether you were investing or riding leverage-driven velocity. Ask yourself whether you had a plan for if it went against you. Because the market doesn't care about your thesis when the structure breaks. It only cares about your risk management. Second, there's you, if you've been bullish on silver for years and you feel vindicated long-term. Maybe you bought in the 30s or 40s. Maybe you've been stacking physical for a decade. Maybe you believe in the inflation story, the debasement story, the industrial demand story. And you know what? You might be right. I'm not here to tell you that silver's going to zero. But timing still matters. Even correct theses can lose money if you ignore drawdowns like this. If you didn't take any profits on the way up, if you didn't reduce leverage, if you're just holding and hoping, you've given back a lot of paper gains. And that's painful even if you're right in the end. The smarter play is to understand the cycle. Understand that parabolic moves don't last. Understand that when your uncle who's never traded in his life starts asking you about silver, that's probably a sign that the easy money's been made. Third, there's you if you've been sitting on the sidelines, confused by the noise, not sure whether to buy the dip or stay away. For you, this is a gift. You're watching excess unwind in real time. You're seeing what happens when leverage gets too extreme. You're learning the pattern without losing money, and that's valuable. Because now you know what to look for next time. Now you know that when something goes parabolic, when open interest explodes, when everyone's talking about the same trade, that's when you need to be cautious. That's when you need to either stay out or manage your risk obsessively. The universal principle for all 3? Markets reward patience far more often than conviction. You can be right about where something's going and still lose everything if you ignore how it gets there. You can have the best thesis in the world and still get stopped out if you don't respect the tape. And you can make more money by waiting for the right setup than by forcing trades just because you're convinced you know what's coming. So here's where I stand. I'm not panicking, and I'm not blindly buying. I'm watching. First, I'm watching whether silver can stabilize around $95 to $100, because that tells me whether the initial liquidation is done. If it can hold there, if it can base for a few days, if volatility starts to cool off, that's a sign that the forced sellers are out. That's a sign that we might be transitioning from mechanical selling to actual price discovery. But if it can't hold, if it breaks below 90 and keeps going, then we're probably headed to the next support level. Second, I'm watching the $70 to $80 zone, which is where deeper deleveraging historically finishes. That's where silver was before this whole parabolic move started. That's where the real buyers were accumulating. If we get back there, if we test that level, that's where I'd expect to see serious physical demand step in. That's where long-term holders might start adding. That's where the reset could actually complete. Third, I'm monitoring volatility and physical premiums. If volatility cools and premiums stop expanding, that's how real bases form. See, when paper silver is crashing but physical premiums are spiking, that tells you there's a disconnect. That tells you the paper market is in liquidation mode, but the physical market is still tight. And that disconnect eventually resolves. Either paper catches up to physical, or physical catches down to paper. Right now, we're in that messy middle where nobody really knows which way it goes. Based on my analysis, this crash was mechanical, not emotional. It was structural, not fundamental. The long-term story for silver isn't dead. Industrial demand is still rising. Supply is still constrained. Central banks are still printing money. All of those things are still true. But the excess had to come out first. The leverage had to get flushed. The weak hands had to get shaken out. And that process is violent and painful and scary, but it's also necessary. Because you can't build a sustainable bull market on a foundation of leverage and speculation. You need real buyers. You need patient capital. You need people who are willing to hold through volatility because they believe in the underlying story, not because they're hoping to flip it to the next guy for a quick profit. If history rhymes and silver stabilizes, the move that follows could be just as powerful as the move we just saw, but built on a much stronger foundation. But that's a big if. And I'm not making predictions. I'm watching levels. I'm watching behavior. I'm watching how the market responds to these key zones. Because the market will tell us what it wants to do long before any analyst figures it out. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Don't take my word for it or anyone else's word for it. Make your own decisions based on your own risk tolerance, your own financial situation, your own goals. If you made it this far, you're thinking critically. That mentality will serve you well. Most people panic or chase or freeze up when volatility hits. You're here trying to understand what actually happened. You're trying to learn the pattern so you can spot it next time. That's how you get better as a trader or investor. Not by being right every time, but by studying the times you're wrong, by learning from other people's mistakes, by building a framework that helps you navigate uncertainty. If this breakdown helped you see markets differently, share it with someone who needs to hear it. Subscribe if you want more analysis like this, and stay ahead of the noise. Don't let the headlines dictate your emotions. Don't let the crowd dictate your positioning. Think for yourself, watch the data, and make decisions before the panic or the euphoria, not after it. Stay sharp out there, think critically, verify the data, and make decisions before the crowd, not after it.